Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Amazon.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and before we really get going, just a quick reminder to check out the VIP Algos link. It's right down below in the description.
Right. Definitely check that out. The link is right there in the description. So I want to start today by just throwing a number at you. $200 billion.
Oh, man. Yeah.
Just sit with that number for a second. $200 billion. That is Amazon's projected capital expenditure for the year 2026 alone.
Which is just a staggering amount of money.
Right. I mean, we're trying to unpack a whole mountain of market intel here. And the main goal today is to figure out why one of the biggest companies on earth is doing this. Because this is one of the most aggressive, most expensive transformations in corporate history.
Yeah, without a doubt.
We're looking at a huge fundamental shift here. The place where you buy paper towels and stream movies, they're attempting to become the invisible backbone of the entire global AI economy.
To really put that $200 billion figure into perspective, I mean, there are entire nations, like developed nations, that don't have a gross domestic product of $200 billion.
Wait, seriously?
Oh, yeah. We're looking at an infrastructure budget for a single calendar year that, it rivals the economic output of a country like New Zealand.
That is insane.
It is. The scale of the physical build-out here is monumental. I mean, they're acquiring the land, pouring the concrete, securing these massive energy grid connections, and, installing millions of highly advanced servers. And it's creating this really fascinating psychological study in how public markets react to that kind of extreme ambition.
Yeah, because that ambition definitely triggered some serious turbulence for the stock. If you look at the timeline, right, in May of 2026, Amazon stock had a 52-week peak. It was sitting at $278.56.
Right. They were flying incredibly high.
Exactly.
Yeah.
But the moment they formally announced this spending plan, the stock dropped 10% almost overnight.
Yeah, the classic CapEx shock.
Right, a capital expenditure shock. So the whole mission for you listening today is to understand whether that 10% dip is, a massive red flag that they're losing control of their budget, or if it's actually a closing window of opportunity for long-term wealth building.
And the tension here really is between massive unprecedented spending and massive unprecedented earnings. They kind of untangle that. We have to look closely at their Q1 2026 fundamentals.
Which were pretty solid, right?
Very solid. I mean, total revenue for the quarter hit $181.5 billion. That's a 17% year-over-year increase. So it paints a picture of a very healthy company overall.
Yeah, for sure.
But the true engine, like the actual machine funding this whole $200 billion endeavor, is Amazon Web Services. AWS generated $37.6 billion in revenue just in that single quarter.
$37.6 billion.
Yeah.
That's a 28% expansion.
Yeah, I think that's right.
That makes it their fastest growth rate in 15 quarters. And the stat that really jumps off the page to me is the profit distribution. AWS accounts for 59% of Amazon's total operating profits.
Yeah, it's huge.
The cloud division it isn't the side business anymore. The retail store is essentially a legacy operation now compared to the sheer profitability of the cloud. AWS generated $14.2 billion in operating income alone.
Which brings us directly to the root of the CapEx shock.
Right.
Because if they are generating billions in operating income, you're naturally going to wonder why the stock took a 10% hit. And the answer really lies in the harsh mechanical reality of what a $200 billion spending plan actually does to cash on hand.
It just drains it.
Exactly. When a company spends aggressively on physical infrastructure, like, vast data centers and AI hardware, their free cash flow just absorbs the entire blow. Over the trailing 12 months, Amazon's free cash flow plummeted from a very comfortable $25.9 billion down to just $1.2 billion.
Wow. I mean, that just looks terrifying on a balance sheet.
It really does.
It's basically like ripping the concrete foundation out from under a skyscraper to upgrade the steel supports, but, all the tenants are still living inside.
That's a really good way to put it.
Yeah. And if you check the bank account mid-demolition, the available liquid cash looks dangerously low, even though the building is fully rented out.
Yeah.
And we actually see that reflected in the operating cash flow, right?
Yeah, we do.
Which is the money generated by the actual daily business operations, selling retail goods, hosting websites, running enterprise software. That number is incredibly healthy. It's up 30% to $148.5 billion.
And that distinction, between operating cash flow and free cash flow, that is the exact mechanism that tripped up the market.
Right, because people just saw the free cash flow number and panicked.
Exactly. Free cash flow is the capital remaining only after you've paid for all those massive physical upgrades. So they are making more money than ever before in their history, but they are just shoveling it into the furnace of the future as fast as it arrives.
And management isn't just emptying the corporate checking account either. They're actually engineering some very specific strategic financing to maintain liquidity during this whole build-out.
Right, the debt strategy.
Yeah, they took out a $17.5 billion term loan, and they did a 14 billion Canadian dollar bond sale. So they're intentionally leveraging debt to keep cash available for daily operations, basically borrowing against their future AI dominance to fund the construction of it today.
They're playing a multi-decade game of architectural dominance. And the natural follow-up here is looking at what that $200 billion is actually purchasing as far as catalysts go.
Because they aren't just buying off the shelf, are they?
No, not at all. They aren't simply buying the future of computation. They're manufacturing it. Amazon has quietly evolved into one of the most formidable hardware chip makers on the planet.
Which is wild to think about.
It is. They're producing custom silicon chips, specifically the Trainium, Graviton, and Nitro lines.
Wait, let's look at the underlying logic there for a second. Because NVIDIA is widely recognized as like the absolute landlord of the artificial intelligence space right now.
Oh, absolutely.
They design the chips everyone needs. So if Amazon has the cash, why are they spending billions in R&D to build their own house rather than just renting space in NVIDIA's luxury apartment?
Well, the answer there is vertical integration. That is their ultimate competitive moat.
Okay, break that down for us.
Sure. So in the traditional cloud provider model, you purchase incredibly expensive processors from a dominant supplier like NVIDIA. And that supplier extracts a massive profit margin on the sale. You then take that chip, place it in your server, and rent the compute power to an AI developer. But because you paid a premium for the hardware upfront, your on-profit margins are permanently squeezed. The supplier holds all the leverage because you literally cannot run the data center without their hardware.
Okay, so by designing the Trainium and Graviton chips in-house, Amazon is just completely removing the middleman.
Exactly.
They pay a foundry to physically print the chips, but they own the intellectual property. So they drop their hardware costs to the absolute floor, and that lets them capture the margin that used to just go straight to their supplier.
And that's the mechanical advantage driving their profitability. In Q1, Amazon's consolidated operating margin hit a record 13.1%.
13.1%.
Yeah, and for a company burdened with a massive low-margin retail logistics network of warehouses and delivery vans, a 13.1% overall margin is just astounding. They own the server racks, they own the fiber optic networks, and now they own the actual microscopic silicon processing the data.
And the market validation for this custom silicon is, it's massive. These proprietary chips have already crossed a $20 billion annual revenue run rate.
Growing at triple digits year over year, too.
Yeah. But the figure that really forced a double take for me is the backlog. Amazon has secured more than $225 billion in revenue commitments specifically for its Trainium chips.
Yeah. That backlog is a huge technical catalyst, and those commitments are coming from the most advanced artificial intelligence laboratories in the world. We're talking about places like Anthropic and OpenAI.
The big players.
The biggest. These organizations require uninterrupted, massive computing clusters to train their next-generation language and multimodal models. Amazon is effectively constructing dedicated, custom-built engine rooms for these specific clients. They are locking in multi-year infrastructure contracts before the concrete on the data centers is even dry.
So if we look at the contrast there, the market panicked over a $200 billion capital expenditure price tag. But Wall Street seemingly just ignored the $225 billion in guaranteed locked-in revenue sitting on the other side of the ledger.
That's exactly what happened.
They reacted to the cost of the materials without pricing in the signed leases.
Right. Analysts view this as a structural transformation into an infrastructure monopoly. And while the mainstream financial press remains entirely fixated on these terrestrial AI data centers, there are some really massive speculative catalysts developing quietly in the background.
The broader market is just totally mispricing right now.
Or ignoring entirely.
Yeah. So if they are building this impenetrable fortress of infrastructure on the ground, It makes sense that they're looking up to secure the data pathways in the sky. Let's talk about the space element, Amazon Leo.
Oh, Amazon Leo is fascinating. It's their low Earth orbit satellite internet network, and it is scheduled for a commercial launch in mid-Q3 of 2026.
Coming up fast.
Very fast. Financial analysts consider this network to be a multi-billion-dollar blind spot for Wall Street forecasters right now. They're actually modeling a target of $10 billion in annual revenue from this network alone by the year 2030.
So they are essentially launching a direct competitor to Starlink.
Basically, yeah.
And the integration mechanics with AWS are what's so cool here. If you deploy a constellation of low Earth orbit satellites, you can beam high-speed internet to, like, a research facility in Antarctica or an oil rig in the middle of the Pacific or an agricultural sensor grid in the Sahara.
Anywhere on Earth.
You bypass local terrestrial telecom monopolies entirely, connecting the customer's data pipeline directly into Amazon's cloud architecture.
It expands the addressable market for Amazon Web Services to literally every square inch of the planet. I mean, providing the transport layer for data is just as critical as providing the processing layer. Yet because of all the noise surrounding the AI CapEx cycle, this massive orbital logistics operation is just barely registering in the broader financial sentiment.
Yeah, people are distracted. And there is another major surprise buried in the analysis, too, which relies on a very specific legal mechanism regarding tariffs.
Ah, yes, the Section 301 tariffs.
Right, there's an unconfirmed but highly lucrative rumor about a massive cash infusion stemming from these tariffs. Explain how that works.
Sure. So Section 301 tariffs were duties imposed by the United States government on thousands of imported goods. And given Amazon's unparalleled import footprint for their retail fulfillment network, I mean, they have paid an astronomical amount in these tariffs over the years.
Oh, definitely.
However, recent rulings by the U.S. Court of International Trade have actually invalidated certain procedures and scopes of those specific tariffs.
Meaning the government collected taxes they technically were not legally authorized to collect under those specific rules.
Precisely.
And because Amazon has the receipts for every single container ship they brought into the country, some analysts are estimating Amazon could be eligible for a retroactive refund of between $5 billion and $8 billion.
And the timing of such a refund would just be a masterclass in financial serendipity.
Really would.
I mean, a sudden, unearned, multi-billion-dollar check from the federal treasury would immediately replenish their rapidly depleting free cash flow. It provides this massive, non-dilutive financial cushion exactly at the moment their capital expenditure is at its absolute peak.
That's huge. But even beyond the legal windfalls, the core retail engine is still just churning out cash.
Okay.
Looking at the near-term calendar, the Q2 earnings report, consensus models revenue at the high end of their $194 billion to $199 billion guidance.
Which is partly driven by the fact that Prime Day was moved to June this year.
Yes, and the Prime Day models project gross merchandise volume to reach $21.6 billion.
That's a lot of merchandise.
It is. For anyone unfamiliar with the specific terminology, gross merchandise volume, or GMV, is fundamentally different from Amazon's actual revenue. GMV is the total dollar value of every single item sold across the platform. So, if you buy a $1,000 television from a third-party seller on Amazon, the GMV is $1,000.
But Amazon doesn't keep all of that.
Right. Amazon's actual revenue is only the percentage they take for fulfillment, advertising, and platform fees. So maybe $150 out of that $1,000.
But the sheer scale of $21.6 billion in GMV passing through their digital registers over just a multi-day event, that really illustrates the underlying stability of the retail division.
It really does.
The retail marketplace provides this reliable baseline stability. It generates the operating cash flow required to fund the wild, really expensive swings on the infrastructure side.
Right. So we've painted a picture of absolute dominance here. But a thorough analysis always requires examining the structural vulnerabilities.
Of course.
So let's talk about the risks, the bear case. What happens if this grand $200 billion master plan hits a wall? Let's walk through that, starting with the primary financial risk, which is the threat of the AI demand cooling before these data centers actually start earning their keep.
Yeah, that's the big one. The global macro environment is experiencing a $725 billion artificial intelligence CapEx cycle right now. Every major technology firm is spending as if the exponential growth of AI adoption will just continue uninterrupted forever.
Which is rarely how things work.
Exactly. The risk is a classic bubble burst. Suppose enterprise companies, the banks, the logistics firms, the healthcare networks, suppose they suddenly decide that generative AI features are not delivering the return on investment they were promised.
Right, so if enterprise adoption stalls out, the software companies stop expanding.
Yep.
And if the software companies stop expanding, the major AI labs like Anthropic and OpenAI do not need to lease as much compute power.
And the problem is Amazon has already purchased the land, poured the concrete, installed the custom silicon, and taken out massive term loans to build for that demand.
Yeah, you cannot unbuild a $20 billion data center.
You really can't. If the underlying demand evaporates, that $225 billion in revenue commitments could face renegotiations or even defaults. For a company already operating with only $1.2 billion in trailing free cash flow, a sudden drop in future revenue realization becomes a severe, potentially existential crisis for the stock valuation.
That's a serious vulnerability. And the risks extend far beyond just the balance sheet, too. Regulators are actively circling the company.
Oh, yeah, the antitrust stuff.
Yeah. There is a major antitrust trial regarding Amazon's anti-competitive pricing practices, and that's scheduled to hit a courtroom in late 2026.
And the mechanics of that antitrust suit strike at the very heart of their retail dominance. The core allegation there often centers on how Amazon uses its platform power, specifically the algorithmic buy box, to penalize third-party sellers who offer their goods at lower prices on competing websites.
Right.
If regulators successfully mandate a breakup of the company or fundamentally alter the algorithms that make the retail marketplace so profitable, it could severely damage the primary cash engine funding the entire AI expansion.
Yeah, that's a massive risk. And then there is also a distinct layer of geopolitical risk, specifically surrounding their key artificial intelligence partners. There's a deeply complicated situation involving Anthropic.
Right. This is an important one. During the previous Trump administration, Anthropic was briefly flagged as a potential national security risk.
Right. And to be clear, we're just reporting the facts here,
Yeah.
not taking any political sides.
Exactly. Just looking at the market implications, the underlying concerns in these types of national security designations typically revolve around the AI, supply chain, foreign investment ties, or just the sheer societal power of the foundational models being developed. But from a purely market-driven, impartial perspective, that specific designation is highly disruptive to a cloud provider.
Consider the implications of that for AWS GovCloud. GovCloud is a highly isolated, specialized region of Amazon's server network built exclusively for government agencies.
It's very secure.
Super secure. It requires extreme security clearances and strict compliance protocols to host sensitive federal workloads. So if Amazon's primary AI partner is suddenly viewed by the federal government as a supply chain vulnerability, it threatens billions of dollars in lucrative government defense and intelligence contracts.
It perfectly illustrates the double-edged sword of becoming the infrastructure provider for cutting-edge, potentially world-altering technology. When you host the foundational models that federal defense agencies are evaluating, you invite intense government scrutiny.
You definitely do.
If federal procurement officers pause or cancel contracts because of security concerns regarding your software partners, the foundation and stability of the AWS growth narrative is directly challenged.
So we have an incredible tension here. On one hand, massive growth, record profit margins, vertically integrated custom silicon, and a $200 billion bid to run the future of global computation.
Yep.
But on the flip side, we have evaporating free cash flow, aggressive antitrust trials, geopolitical supply chain vulnerabilities, and the ever-present threat of an AI bubble popping. So, synthesizing all of this for the listener, what's the final verdict? How does the financial community ultimately weigh these factors?
Well, when synthesizing the overarching thesis from the financial analysis and the market intel, the consensus leans heavily toward the positive. Amazon currently holds an 8 out of 10 bullish score as a multi-year hold.
An 8 out of 10 represents incredibly strong conviction despite the obvious short-term headwinds.
It really does. The rationale behind that score is that the underlying fundamentals of the transformation are just simply too strong to ignore. The short-term pressure on free cash flow is an undeniable reality, but it's a conscious strategy.
Yeah, they know what they're doing.
Exactly. You have 28% revenue growth in AWS. You have expanding profit margins driven directly by the successful deployment of custom chips. The $200 billion infrastructure pivot is not viewed as reckless spending by analysts. It's viewed as a calculated, necessary expenditure to cement an insurmountable lead in the next era of computing.
Yeah, and by understanding the mechanics we've explored today, the entire narrative really shifts. If you simply read the headline, Amazon stock drops 10% on CapEx shock, you might assume the company just lost control of its budget.
Right.
But by looking past the headline, understanding the difference between operating cash flow and free cash flow, and looking at the unit economics of custom silicon, you see a masterfully executed structural transformation.
It just requires separating the short-term market noise from the long-term strategic signal. The signal clearly indicates that Amazon is securing its position at the absolute foundation of the new economy. With potential blind spot catalysts like an $8 billion tariff refund and the launch of an orbital satellite network, the market is currently mispricing multiple avenues for massive value creation.
I think that's a great summary. And I want to leave you, the listener, with a final thought to mull over today. Something that kind of reframes everything we've discussed.
Mm-hmm.
For the last 2 decades, society has universally known Amazon as the everything store.
Yeah, the ultimate digital retailer.
Right. It fundamentally changed how humans acquire physical goods. But look at the reality of their operations today. They're designing their own microscopic silicon processors. They are riding the momentum of a $725 billion artificial intelligence macro cycle. They're launching an entire constellation of satellites into low Earth orbit to control the global transmission of data.
It's a completely different company.
It is. So perhaps we need to stop viewing them as a retailer entirely. Are we witnessing Amazon's final evolution from a marketplace where you simply buy things into the invisible, omnipresent utility grid that provides the power, the processing, and the connectivity for the entire modern economy?
That is a phenomenal question to consider.
Think about the invisible grid. And if you enjoyed today's talk, don't forget to subscribe, like, and comment underneath.
And definitely grab that VIP Algos link down in the description.
Absolutely. The VIP Algos link is below. We will catch you on the next one.